PayPal stock is now down over 22% since its earnings report a few days ago, and is really staying true to its name, PayPal. So in this video, I want to go through their recent earnings and their financial highlights to see what's happening with this company, and is it even worth investors looking at this company anymore, or if it's just a value trap. So if you like this content, please like and subscribe. And my Patreon still has a few open spots left at the discounted rate. Joining my Patreon, you get access to everything here at the Bearded Investor community, the Substack, the Patreon buy and sells, access to real-time chat and AMA. So you get a lot of value for the discounted rate. So if you like that, please consider joining. And with that, let's get straight into this content about PayPal. Now, PayPal reported earnings on February 3rd, which was a few days ago, their fourth quarter and fiscal year 2025 results. Looking at their investor presentation here, second year of diversified profitable growth, transaction margin dollars, excluding interest, increased 6% year over year, and non-GAAP EPS increased 14% year over year in 2025, taking near-term action to restore online branded checkout momentum, scaling experiences, improving presentment, and driving selection. This is the key thing that I think investors need to look at, is their online branded checkout. Been in the doldrums for many years now, and this is what needs to improve. So I'm glad that they're at least pointing it out in their investor presentation. Making targeted growth investments across branded checkout, buy now, pay later, BNPL, consumer engagement, and agentic, driving durable growth across PSP and Venmo. So PSP TPV, total processing volume, increased 8% year over year. Enterprise payments TPV growth back to double digits. So that is good to see. Accelerated Venmo revenue to $1.7 billion. Growth increased to 20% year over year in 2025. Expect to generate $6 billion of adjusted free cash flow in 2026, returning $6 billion via share repurchase back to shareholders. So say what you will, they are still generating a ton of free cash flow from their business, and they're still returning a ton of shareholder value through their share repurchases. So that's one thing that, critics can't say, that they're not returning value back to the shareholders. But their growth is pretty small and pretty low compared to competitors in the space. Growth is diversifying. Strategic initiatives contributed to faster transaction margin dollar growth in 2025. Revenue excluding interest on customer balances on spot. Fiscal year 2024, 6%, and fiscal year 2025, 5%, so it's decreasing. Transaction margin dollars excluding interest on customer balances spot actually grew 1%, but still super low percentages. They're trying to grow their branded experiences section as well. Product innovation working, implementing new go-to market approach to restore momentum. They're working on their experience, deliver a modern checkout experience, fast, intuitive, consistent. Presentment, win the moment of choice by ensuring PayPal is surfaced clearly, early, and competitively. One thing in this space is they have tons of competitors, so they have to be able to win the choice for the customer. Now, Venmo and Omni are high points of their investor presentation here. $1.7 billion in growth, so $1.7 billion in Venmo revenue, which is 20% growth, which is one of the highest growth numbers you'll see in PayPal. And then Omni also has 60% growth, $35 billion global debit TPV, and you're having greater than 10 million in debit first-time users, 100 million in Venmo active accounts, greater than 45% global debit MAA growth, 67 million in Venmo MAAs, 7% growth, 700,000 plus UK and Germany debit MAAs. So it's doing really well in Europe. 14% ARPA growth, 3x US debit versus checkout only ARPA, and then 31, which is 9% growth in Venmo TPA. So this is a slide that I showed in a previous presentation on PayPal, and you can see that they're trying to re-accelerate their PSP profitability here. PSP TPV growth accelerated to plus 8%. Foreign exchange neutral, with enterprise payments TPV growing double digits in Q4. And here they are slowly getting out from the gutter here from first quarter of 2025 and second quarter of 2025, and then growing enterprise payments TPV growth, foreign exchange neutral, into third quarter and fourth quarter 2025. So at least they are recovering here and growing in this segment. deepening merchant relationships with integrated value-added services, payouts, payment optimization, foreign exchange as a service, risk and fraud, and omni-channel. And then finally, scaling next-gen growth vectors. They're doing strategic relationships with top AI platforms. A lot of news came out recently with their partnerships with Perplexity, with OpenAI, Microsoft, Google. They're trying to get into all of these avenues and channels, trying to win that AI. So PayPal Store Sync and Checkout Live and Perplexity and Microsoft. And PayPal will be a payment option in the future for Google and OpenAI. So Store Sync is basically making merchants' product data discoverable within AI channels. And PayPal does have a incredible, warehouse of data, customer data available for merchants to utilize and take advantage of to market their products. They know exactly what products that their customers have bought and are interested in. So these merchants find that data very valuable. So that's one thing that PayPal can lean into and take advantage of. Merchants remain the merchant of record, and our planned acquisition of Symbio enhances our capabilities, and so we can talk about that acquisition a little bit later. So let's look at their fourth quarter and full fiscal year 2025 snapshot of their numbers. So fourth quarter 2025, TPV came in at $475 billion, which is 9% year-over-year growth, 6% foreign exchange neutral. The revenue was $8.676 billion, which is 4% year-over-year growth, 3% foreign exchange neutral. Transaction margin dollars came in at $4.034 billion, which is only 3% year-over-year growth. Super low numbers here. Transaction margin dollar excluding interest on customer balances was $3.741 billion, 4% year-over-year growth. Non-GAAP EPS was $1.23, 3% year-over-year growth. And adjusted free cash flow was $2.095 billion, which is no change in year-over-year growth. Now going to the full fiscal year, they did $1.793 trillion in TPV year over year, which is 7% and 6% foreign exchange neutral. Revenue came in at $33.172 billion, 4% year over year growth, 4% foreign exchange neutral. Transaction margin dollars at $15.465 billion, which is 6% year over year growth. Transaction margin dollars excluding interest on customer balances, $14.235 billion, which is 6% year-over-year growth. Non-GAAP EPS, $5.31, 14% year-over-year growth. And adjusted free cash flow was $6.411 billion, which is negative 3% year-over-year growth. So what I'll say about these numbers are low. Adjusted free cash flow went down, actually negative year-over-year. And it's just not showing the growth from all these initiatives that they're rolling out. Now looking at their account and activity metrics, Q4 2025, active accounts was 439 million. Full fiscal year was 439 million, so no growth there, 1% year-over-year growth. Monthly active accounts, MAA, 231 million, and this full fiscal year, 227. So year-over-year growth of 1% and 2% respectively. Number of payment transactions, 6.754 billion. And for full fiscal year, 25.355 billion. It's actually down 4% for the full fiscal year, year over year. It's up 2% for the fourth quarter, year over year. Number of payment transactions, excluding PSP, unbranded card processing, 4.284 billion and 16.07 billion in full fiscal year, which is both 6% year-over-year growth for both. Transactions per active account, TPA, 57.7 and 57.7 for full fiscal year as well. Year-over-year growth of negative 5% for both. TPA excluding PSP, 36.6, 36.6, and year-over-year growth of 5% for both. Active accounts, that 1% increase and the MMA increase of 1% was largely driven by Venmo, and the number of payment transactions returned to growth, plus 2%, with 12-month trailing TPA minus 5%, reflecting price to value actions that drove lower enterprise payment transactions. Number of payment transactions excluding PSP, positive 6%, and TPA excluding PSP, positive 5%, reflects customer engagement with transaction growth in branded experiences, debit and branded checkout, and Venmo. Now you can see that branded checkout deceleration driven by weakness in US retail, international headwinds, and tough comparisons in high growth verticals. Operating margins and operating income. So operating income was 1.55 billion for fourth quarter, and for the full fiscal year was $6.378 billion, which is 3% year-over-year growth and 9% year-over-year growth, respectively. Now, the one good thing I'll say is that their, operating income is increasing faster year-over-year than their revenues, even though both are under 10%, under double digits. So I guess that's good, but these should be a lot higher for a company with this type of data, with number of customers, with this type of rollout of initiatives. It should be much higher. So it's really speaking to disruption here and the erosion of a moat. Their guidance for first quarter of 2026, transaction margin dollars, slight decline. Transaction margin dollar excluding interest on customer balances, roughly flat. Non-GAAP effective tax rate, 19% to 21%. Non-GAAP EPS growth, mid-single digit decline. GAAP EPS growth, mid-single digit decline. Really not exciting there. For full fiscal year 2026 guidance, transaction margin dollar decline. Transaction margin dollar excluding interest on customer balances, roughly flat. Non-GAAP, non-transaction operating expenses, roughly 3% growth in expenses, operating expenses. Non-GAAP effective tax rate, 19% to 21%. EPS growth, low single digit decline to slightly positive. EPS growth, mid-single digit decline. Adjusted free cash flow, $6 billion. Share repurchases, $6 billion. And CapEx, around $1 billion. So if you're looking at these numbers and this guidance, there's not really much here. It's mostly declines to roughly flat. So there's not really any growth here that I can speak to. And the only thing that's exciting for me as a potential shareholder, if I was to get some shares of this, would be the adjusted free cash flow of $6 billion and the share repurchases of $6 billion. Now let's move on to some of the news that's coming out in the headlines. Let's talk about their acquisition of Symbio and also some other news regarding their leadership that we need to react to. So the first one I want to react to is PayPal acquiring Symbio. And Symbio is basically a multi-channel orchestration platform that helps brands sell across agentic surfaces. So it's an AI product that helps merchants sell with PayPal across agentic surfaces, including Microsoft Copilot and Perplexity and other e-commerce channels. PayPal previously partnered with Symbio as part of its agentic commerce services, a suite of solutions that allows merchants to attract customers and drive sales in a new era of AI-powered commerce. PayPal has established itself as a leading commerce partner for merchants looking to sell within top AI platforms, and acquiring Symbio's technology and team will enhance our agentic commerce capabilities and accelerate the expansion to more of our merchants. By making their product catalogs discoverable on AI surfaces, merchants can increase sales while expanding product choice to millions of consumers shopping on AI platforms today. So this is a good acquisition for PayPal, I believe. I think it keeps them relevant, at least in the agentic AI space, and it's really necessary to stay in the AI commerce, e-commerce space as well. But this is a good acquisition, in my opinion. PayPal's agentic commerce services and checkout options are available for merchants on Microsoft Copilot and Perplexity, with OpenAI's ChatGPT and Google's Gemini app and AI mode are coming soon. So this transaction is expected to close in the first half of 2026, subject to customary closing conditions, and the deal terms were not disclosed. So it could be a good acquisition, but we really have to wait until we see what the deal terms are. The other huge news that came out of PayPal recently is that they've replaced Alex Chriss as the CEO, and they have appointed Enrique Lores as the Chief Executive Officer and David W. Dorman as the independent board chair. So they were not satisfied with Alex Chris's performance and results since he was instated as the CEO. They got Lores, who's coming from HP, and now he's about to run the PayPal organization. And they're saying Enrique is widely recognized as a visionary leader who prioritizes customer-centric innovation with demonstrable impact. His strong track record leading complex transformations and disciplined execution on a global basis will ensure PayPal maintains its leadership of the dynamic payments industry now and into the future. So I'm not sure how this is going to shake out. We'll have to wait and see to see if he's going to lead PayPal in a way that will lead to innovation and pushing their products that are different differentiated from their competitors, because that's what they really need. They need something that's so innovative that it sets them apart from all of this competition in this space. And that will start changing the revenue growth. That will change the earnings growth. That will change the numbers for transaction margin dollars and everything going forward. All these metrics that we look at for PayPal, those need to start increasing and get closer and closer to double digits. So I'm not sure if he's the guy for that, but we're just going to have to wait and see. So let's look at their metrics just before we get into the valuation on Simply Wall Street. Here on Fiscal AI, their market cap is now $36.73 billion, which is crazy to think about because just a few months ago, I was looking at PayPal and it was $70-80 billion. Literally been cut in half again. So their enterprise value is $38.61 billion. And the difference between the market cap and the EV enterprise value is their debt, essentially. So they have about close to $2 billion. So they have $1.87 billion in debt. They have 920 million shares outstanding. They have about 33.17 billion in revenue, like we discussed earlier. And they have about 23,800 employees. I would like to see them reduce the employee headcount if they could, because they are not in a position to be having this many people, this many employees. It would really help their bottom line if they did reduce their employee headcount. Now their margins, 41.5% to gross margin, EBITDA at 20%. Operating margin 18.7%, pre-tax is 19%, net is 15.8%, free cash flow is 16.8%. That free cash flow margin is pretty good at 16.8%. Now looking at their PE is 7.4, like super cheap. Price to book is 1.8, EV to sales is 1.2. Looking at their next 12-month price target is 81.54 from analysts. If their PE is going up to 11.1 for the next 12 months, that means that their earnings may be going down over the next 12 months. PEG is 0.5. So if you're just looking at this company on a PEG metric, this is dirt cheap and it's undervalued looking at this number. Severely undervalued. EV to sales is 1.7, EV to EBITDA is 8.1. Price to free cash flow is 7.4. They have around $10.4 billion in cash. They're well capitalized. Their debt to equity is 0.6, so well under 1. EBIT to interest is 14.1. So going to Simply Wall Street to look at their valuation, I go to the valuation section. So looking at their valuation, they're super undervalued right now. This is using an excess returns model because PayPal is essentially a bank now. They applied for their banking license and they've pretty much converted into a bank financial institution. So using the excess returns model, we're getting a fair value of $116.62. The current price is around $40. So that's 65.3% undervalued. And the way that they're getting this is using excess returns, like I said. The stable EPS is $6.06. Book value of equity per share is $26.58, and that's from 7 analysts. The discount rate, cost of equity, is 7.8%. Perpetual growth rate is 3.4%. The equity risk premium is 4.5% from S&P Global. So they take the beta and re-lever it for this financial institution. They re-lever that beta and they get 7.83% for the discount rate. Using the excess returns formula, stable return on equity minus cost of equity multiplied by the book value of equity per share, and that results in $3.98. The terminal value of the excess returns is excess returns, $3.98, divided by cost of equity minus expected growth rate. So you get about $90 there. Add the $90 to the book value per share, which is $26.58, and you get $116.62. So what am I doing with PayPal? There's just too much competition in that space. I think there are real issues in the company, and I'm not even sure if this new management, new CEO, can effectively address those. And I place it in the too hard to analyze pile for right now because there's just too many unknown variables to address in this company. Are there things that are positive? Yes, there are certain things that are positive, such as their free cash flow and their share buybacks. That share buyback should increase their EPS at least and lower the share count going forward. So that's it, guys. That's my update on PayPal. If you like this content, please like and subscribe. It really helps my algorithm grow. And with that, I'll see you guys in the next one.